Bank of America and Citi reporting first quarter earnings this morning, beating on the top and bottom lines and following a trend of strong Q1 bank earnings. For more, we're bringing in now Gerard Cassidy, analyst at RBC Capital Markets, covering the banking sector. Gerard, it's great to see you as always. So listen, the bank earnings, they continue to roll in. Gerard, we heard from Bank of America and Citi this morning. Investors clearly liked what they heard there. Both those stocks are higher in today's trade. Broadly, how would you characterize what we've heard, Gerard, from the sector you know so well? I mean, it has seemed generally positive, Gerard.
Josh, you're absolutely right. The results have been good. The banks have generally beaten all of our estimates on the street consensus, EPS estimates, as well as my own. And I think part of the reason is, of course, the capital markets businesses for the large money center banks and for Goldman and Morgan Stanley were really strong in trading, particularly equity trading. So that was a large reason for the beats for most of these companies. Also credit. Credit remains very resilient, even though they're building up reserves as they're required to do under the new accounting standard called CECL, current expected credit losses. When I say new, it's January of 2020 when it was introduced. So I think what we're seeing is that, the first quarter, of course, has 2 months of no commentary about tariffs. It was only in March that the commentary started to be elevated. In April, of course, has been very volatile. So I think what we're seeing is first quarter results overall were better than expected. Credit's strong, capital levels are very healthy, liquidity's high. It's really the future and the unknown of the future that has everybody on edge.
How long do you think the elevated volatility, that the trading volume that comes from that, can make up for muted deal activity? Can that continue for a couple of quarters, or is there a limit to how far that could take you?
It's a really good question because it was outstanding in the first quarter, and it did more than offset, the lower numbers in some of the selected investment banking categories, particularly ECM, equity capital markets. The IPO market has really kind of fizzled out here due to this volatility. So you really need volatility and volumes to go with it to enable these larger firms to offset any slowdown in activity in advisory, which is M&A activity, of course, and then the ECM business. The DCM, debt capital markets, had a very strong first couple of months of the year. It has slowed down a little bit. So you're right, we will need to see elevated volumes and volatility if the investment banking markets don't come back. Ideally, if we could have some resiliency in the markets and less volatility, you might get a combination of lower revenues in trading, but more than offset by incremental pickup in the advisory and the ECM business. So we'll have to see how that plays out. But right now, the uncertainty is really weighing on the ECM and advisory business at this time.
Gerard, let's say we do see, a material economic slowdown in the U.S. How should investors think through what that would mean for your coverage universe?
It's a good question, and it's really the $64,000 question, because the biggest swing factor to earnings is credit and credit deterioration. And if we were to have a meaningful downturn, a bona fide recession that lasts, let's call it 6 to 12 months, in the summer of 2026, unemployment's approaching 8%, that would be very bad for the banks. No doubt about it. Credit losses would go much higher, and the stocks would suffer accordingly. But if we're in for a slower growth period or a mild recession, similar to what we saw in 01, 02, then the bank stocks are going to navigate through that much better than I think people realize. They have been de-risked ever since the financial crisis. They've been going through the annual stress test that is put on by the Federal Reserve, and this has forced the banks to take less risk on their balance sheets. So they should navigate through any slowdown better than they did, of course, in 08, 09. I would also point out that the capital levels are very strong. We're going to see, I think, a lot of capital actions this year in terms of share repurchases. The number yesterday, Goldman put up a $40 billion buyback program that they can on. And if they were to execute all of that, what's amazing to me is that that's over 20 20% of the shares outstanding for Goldman.
Gerard, looking broadly at leverage, if you look at the S&P 500, leverage looks really, really low, like almost all-time lows. And yet all we talk about are private credit markets. When you're doing your research and you're talking to executives, what do they think the real answer is? Is there a lot of leverage or a little leverage right now?
We're back.
Just repeat that.
Sure. Just to repeat the question, leverage is very low in the S&P 500, but all we talk about is private credit. And what is the right answer? When you talk to executives, do we have a lot of leverage or a little leverage in the system right now?
Yeah, it is really the right question to ask on credit, because the private credit sector has grown so meaningfully over the last 3 years, particularly since 2023. You might remember that was when the Federal Reserve introduced what they called at the time the Basel III Endgame proposal. And that proposal was going to require banks to carry considerably higher levels of capital. And the banks went on what they referred to at the time risk-weighted asset diets, meaning they were pulling back from lending, and the private credit markets seized the opportunity to grow more aggressively. So right now, the Bank of England has made an estimate that the private credit outstanding globally is well over $1.4 trillion. So there's certainly leverage out there in the private credit market. Generally, the banks do not have direct exposure here. There is a second derivative exposure where they're lending to some of the private credit lenders and the private equity players. And it'll be interesting to see if we go into a downturn. Quite often what happens in the past, what has happened in the past, is as the problems start to mount, the regulators force the banks to deal with the problems aggressively. You don't have that in the private credit markets. There's no regulator. So the private credit lenders can be more creative in the way they solve those problems. They could stretch out the payments. They could organize a payment in kind type of offering. They could be much more creative. So we may find out that the private credit markets, though they may be hit, could handle it better because they don't have regulators breathing down their back.
I think they used to call that extend and pretend back in the day.
Yes, you've got a good memory, or kick the can down the road.
Gerard, I'll end here. You have a few different buys, Gerard. If I was to pin you down, though, I said I need your number one pick. What would you tell me?
Josh, I would point to Wells Fargo, and the reason being they have the idiosyncratic issue of the asset cap. You might recall they've been sitting with the cease and desist order from the Federal Reserve since February of 2018, which included an asset cap. Secretary of the Treasury Bissett has made it very clear he wants the banks to get more involved lending in to the market. This would be a great way to back up the words with actions and have the Federal Reserve lift that asset cap. We believe it's going to happen this year, possibly in the second quarter of this year. So Wells would be the stock to own because we think they're going to get to grow finally after 7 years of being in purgatory.
And speaking of draw, we have Treasury Secretary Bissett coming up shortly. I know you'll be listening. Gerard, it is always great to have you, always great to listen to your analysis of the sector and get your picks, sir. Thank you so much for joining us.
Thank you, Josh. Thank you.